Back with India Market Open, and something that we do with Team Citi at the end of every quarter is try and assess whether the outlook for the next year or the remainder of the year has changed or not. And we continue that with this very special conversation with the Citi think tank on the Outlook FY26. Joining me in the studios, Surendra Goyal, Head of India Research at Citi, Kunal Shah, Director of India Bank's Financials at Citi, Arvind Sharma, Director, India Autos and Transportation, and Saurabh Handa, Head of India Oil and Gas and Telecom. Gentlemen, all of you, thank you so much for taking the time out. It's a pleasure having you once again. I look forward to the next 20-25 minutes of the conversation. Can I start with you, Surendra? What did you make of the year gone by? And what's your immediate outlook, or in other words, Outlook FY26? And I would urge you to break it into two halves if that is necessary, because when we were looking at the end of the first half last year, we were thinking what a beautiful base effect FY26 will have in the first half. So is that a material factor for growth and for earnings growth?
Sure. So if I look back first at FY25, I think after multiple very strong years of growth, it was a bit of a normalization year, where earnings growth slowed down to, say, mid to high single digits year over year, which is well below the kind of trend we have had for the prior four years or so. In terms of what we see going forward, I think we should see a recovery as we go forward. Firstly, the recent data points around GDP growth, around GST collections, etc., have been pretty encouraging. And fourth quarter, even on the investment side, from the GDP print, the data looks pretty strong. So I think, and then on consumption, on the urban side, we are expecting a bit of a recovery because of the rate cuts and the tax slab changes, etc. Those should kind of help consumption as we go forward from here. Rural data points, the high frequency indicators are anyway suggesting some strength. So I think overall, it does look better as far as the FY26 is concerned. So what we are expecting is that GDP growth should kind of be closer to above 6.5% for next year, and earnings growth in low double digits, which will be an improvement over the trends that we saw in FY25.
Okay. And would consumption play a very important part in this low double-digit earnings growth delivery, or would it be capex driven?
No, so we are expecting some recovery. Now, obviously, there are a lot of moving parts, so we really need to see how this plays out. But I think the tax slab changes, they came into effect from April 1st. And then you have the rate cut cycle, which is still going on. I think all of those things should help. And then as we go forward to FY27, I think the pay commission should also kick in, and that should also help consumption. So we do expect directionally consumption, particularly on the urban side, to see some recovery as we go forward from here. So I think at this point, the way I would put it is that consumption should see some pickup. Quantum of pickup, I think a lot of moving parts, we really need to see how it plays out.
Okay, one more follow-up, Surendra. As the CA put at the end of this GDP GVA data, that India is growing in a growth scarce world. Does this elevate the multiples for a market like India in the minds of global investors, or do the higher multiples become a factor which negates the positives?
No, absolutely. So we do come across this in many of our conversations, right? Like, for example, at times we may feel that, okay, it should have been closer to 7 and we are at 6.5. But then when we meet overseas investors, like, where do you get 6.5? Right? So clearly it is a growth scarce world. And in that, I think growth countries, growth companies, I think everybody does get elevated valuations. And we have seen it across sectors in India also, that growth kind of gives you a disproportionate premium today compared to, say, 5 years or 10 years back. So it is in that context, I think growth definitely today is much more difficult. And I think that way India clearly stands out. As among the sizable industries, I think the growth rate is clearly significantly ahead of others.
Okay, so elevated multiples very likely in select pockets and market-wide as well. Okay, can we see that in the financials? And would there be a case of two halves? I would love to understand from you. For the longest time, banks saste hain, let's go out and buy banks. Suddenly the outlook or the narrative seems to be, at least I hear on air from a lot of people, that with the rate cut cycle on the anvil, maybe the time to prune the exposure to banks and look at NBFCs because the cost of funds will go lower. How do you look at FY26?
Yeah, so clearly we need to look at it from two halves perspective because in the first half with the repo rate cut and the immediate repricing of EBLR linked portfolio, there would be pressure on margins and the deposit cost benefit catch up will come towards the second half and the next year. So from our assessment, we believe Q3 is where the margins will actually bottom out. So it will start to come off from Q1 onwards and almost like say 25 to 30 odd basis points kind of margin is what we are building in, which will be visible in terms of say from the exit quarter of Q4, you will see 25-30 basis points kind of a decline, which will be more evident in third quarter, and thereafter you should start to see the improvement in the margins with the deposit cost catch up. And banks have initiated a lot of action. So when we look at it like all through the rate hike cycle, there was no tweaking of savings deposit rate for the first time. Like as soon as we saw 50 bips of repo rate cut, there was 25 basis points of savings rate cut which happened, which immediately gives you, given that 25% of overall deposits are savings, it immediately gives you benefit of 6 to 7 odd basis points, which will reflect in the first quarter itself. And then they have tweaked the term deposits, like last week itself, most of the leading private banks further cut it by another 20 basis points. Earlier, they had already cut it by 25 basis points. So cumulatively, if we look at it, 45 basis points of TD rate cut has already been initiated by the leading private banks. Obviously, the effect of that will flow through with a lag because on an average 18 to 24 months is the maturity of the deposits. So, but otherwise, when you look at it on the asset quality side, it clearly seems, particularly on the unsecured lending, it's stabilizing for many of the frontline banks. MFI might still take a couple of quarters of higher credit cost, but besides that, we are not seeing pain in any of these segments. So there is no spillover effect of the stress, be it on the retail secured or MSME or even corporate is behaving quite well. And I think the overall credit cost will still continue to support earnings for banks. So no doubt there will be some pressure at the NII level, but credit cost and operating efficiency is something which will play in with respect to the overall earnings growth. And I think FY27 earnings will be relatively better. FY26 could be still lower in, say, for many of the frontline banks, it could be low in single digit as well.
Okay, so I'm going to stick to banks for now and then we'll revisit NBFCs later on. But just on banks, yesterday my colleague Sajid was saying ICICI Bank has put out a notice that I think from June 1st or July 1st, they are ramping up charges on all. At the same time, some PSU banks are saying we are going for zero cost or zero deposit accounts as well. So clearly, private banks seem a lot more confident in hiking charges, passing them on, etc. Are they confident of retaining customer base and therefore CASAs? And what's your pecking order when it comes to private banks? Let's stick to banks for the time being.
Yeah. So in terms of fee income, that is going to be the another lever. When you see some pressure on margins, you would want to offset it by fee income levers. So as I mentioned, like OPEX efficiency and credit cost is there. The another lever which they are trying to further maybe nurture is the fee income, and that's where we are seeing some charges being raised. Maybe, but obviously this is for the services, for the convenience, and they are relatively better compared to that of the other banks. So to that extent, I don't think there will be too much of, maybe if you look at it in terms of whether there will be outflow because of any kind of a charges, doesn't seem to be the case at this point in time.
What's the pecking order in banks?
So we like HDFC Bank, that's our top pick, followed by ICICI and Kotak.
Okay, so HDFC, ICICI, Kotak. You're sticking to the large ones?
Yeah.
Okay,
Absolutely.
Okay, fair call. Arvind, thanks and good to see you back. Now on autos, let's start with autos per se, and toying with how it seems to have become a very, very bottom-up idea, because whether four-wheelers or two-wheelers, it doesn't seem to be a homogeneous sector. There are very isolated cases of outperformance in an otherwise very fragile performance in the last few months. How would you characterize the auto sector right now?
Absolutely. I think four-wheelers and two-wheelers both have given very disparate set of volume numbers and margin numbers. I think in the four-wheeler sector, the absolute volume growth has been lower, thanks to the slightly higher base. And even for FY26, the volume growth expectation is barely low to mid single digit, more low single digit. For two-wheelers, the base is slightly more benign, so we are mid to high single-digit kind of a growth expectation. Also in two-wheelers especially, the competition is intense. Look at the 125cc, that's almost like a new 100cc. So you have literally every player jostling for that market share. And when you have a jostle for market share, obviously pricing takes a bit of a hit. In passenger vehicles, clearly we have premiumization. Small car demand has been weak for some time now, and UVs have been quite strong. Again, in UVs also, you look at some of the more premium and UVs are selling even better. Like if you have a same model, the higher variant sells well. So premiumization is more salient in four-wheelers. In two-wheelers, again from 100 to 125cc, that's the trend we are seeing. In even more premium bikes, talking about 350cc and above, the numbers are better than the other bikes. So premiumization is common, but growth rates are disparate. Also, what we saw, especially in fourth quarter, in four-wheelers especially, there has been a lot of advertising, brand promotion, sales and marketing expenses, which have impacted margins. Right? But going forward, I think most companies, and this is common between two-wheelers and four-wheelers, have taken a call that the focus needs to be on market share and volumes, not necessarily on margins. This is something which saw in fourth quarter, and commentary also clearly signifies that it's absolute growth that we are targeting instead of just percentage margins.
How would you as an analyst reward that or punish that, part one? And what's the pecking order? Because when I read all the notes from your peer sets, all brokerages, there seems to be almost a consensus around maybe a Royal Enfield or Eicher, TVS, M&M, and maybe a Maruti for the valuations. That seems to be the universe that everybody is battling in.
Right. So our top picks are Maruti and Mahindra in that order. Among the two-wheeler majors, we like Eicher Motors, which is Royal Enfield, right? Yeah, that's how we will pick it. Clearly, we are targeting. We see companies where there is a self-help story. In Maruti, for example, exports is a big thing. You saw the numbers yesterday. That helps, and some of the macro tailwinds like tax rate restructuring, interest rate cut, they would also likely boost Maruti's volumes. Right. For M&M, the UVs have done incredibly well, especially the upper end UVs. Tractors, again, most of the commentary on monsoons and farm income are favorable. And Eicher Motors, again, I think competition is something that they have clearly warded off very well in terms of Royal Enfield. And there is no imminent competition from electrification. So they are the leaders in the segment they are in. And in Eicher's case, very clear focus from the commentary we saw. It has to be volumes and absolute profit growth rather than only percentage margins, which are actually lower this quarter versus most expectation. But volumes is something which is being rewarded.
Okay, and maybe that is what will last. Just before I come to Saurabh, by the way, Saurabh, lovely color on the suit, I must say, man-to-man, brilliant one. But Surendra, does that tie in with this thought about consumption selectively moving up? Will premiumization be the thing, or does rural bouncing back mean the delta will be more at the lower end versus the premiumization end?
So see, the way we are looking at it, I think overall consumption should get a bit of a lift. But within that, I think there are segments of the market where there is intense competition and fragmentation. Okay, so you may not see players in those pockets of the market benefiting a lot. Okay, so I think that is something which will need to be kept in mind, and that kind of always leads to a fairly narrow set of names in consumption. Okay, and again, I can't talk stocks, but if you look at our top picks, there are a few names, and again, they come out as a follow-up from that, where we are expecting some improvement in consumption, but within that we want to avoid spaces where there is a lot of fragmentation and increasing competition.
So does it form in staples or discretionary?
Yeah, so bulk of our preferred stocks fall in discretionary.
Ah, okay. And does autos form a part of that discretionary side of the consumption, or that's a separate segment?
Yeah, so autos is discretionary obviously, but like within our top picks, we don't have a lot of names from autos at this point of time. We turned more neutralish on autos in the latter part of last year because our view was that the best part of the growth from a cycle perspective was behind us, and margins for a lot of these companies are at close to cyclical highs. So the opportunities in autos were getting more limited. So we do like select names which Arvind mentioned, but in general, a lot of picks are on consumer discretionary ex-auto side.
Got it. Okay. Now, Saurabh, where does oil and gas? Can we start off with that? Then we'll talk about telecom too. But where does oil and gas fit in the scheme of things? Considering that one, the underlying commodity, which is crude oil, let's say one of the underlying commodities, is going through a period which is almost becoming very difficult to predict. Saudi Arabia suddenly wakes up and says, okay, now we're taking leadership, going ahead and hiking output, and crude prices from the lows move higher as well, but still in a very comfortable zone from a macro perspective. How do you look at oil upstream or oil downstream for that matter?
Yeah, so I mean, broadly, Citi's view is that we are here for maybe lower for longer oil prices. So at least our view is maybe in the $60 to $70 range over the next maybe 12 to 18 months. So that works perfectly for India from not just a macro perspective, but within the sector, then, you know, downstream stocks do tend to benefit. So we do like the OMCs. We have buy ratings, in fact, on all three of them. They had a bit of a challenging period last year because on the LPG front, they were making losses. Now, if crude stays at these levels, say below $70 or $75, then you potentially have a situation where even the LPG losses are taken care of because of the good marketing margins they're making on the transportation fuels. So I think OMCs, and also because this is one sort of pocket of the sector which has always been value to deep value, it's always sort of oscillating between that. Now you do have value, but you have catalysts, potential upside to earnings, very attractive dividend deals. So OMCs we would be, you know, biased positively on. On the opposite side, upstream potentially could get hurt because of this, because the government, while they have, you know, removed the windfall tax, but the fact is your absolute oil prices are quite low now, which hurts upstream realizations. And even on the gas front now, upstream realizations are linked to oil prices. So as oil prices start going down, it also hurts them on the gas front. Yeah, so that's how we would look at least, you know, within the sector. And overall on oil prices, yes, there's a lot going on. There's geopolitics on one end, but there's a fair bit of OPEC spare capacity which is still in the system. Non-OPEC countries are still showing pretty decent growth, and there are question marks on demand right now globally. So which is where our view is that, you know, $60, $70 sort of range over the next maybe year or so.
So this marketing margin gain penciled in for the last 4 or 5 months in the minds of almost everybody.
Yeah.
You are saying the difference between the last 5-6 months and the future 12 months is the fact that the LPG under recoveries would be accounted for, and therefore now it will start showing in the numbers and thereby maybe the returns from the OMCs.
Yeah, so firstly, obviously last year your average crude price level was a lot higher. It was in the 70s. You're now potentially looking at it in the 60s.
But second half, Saurabh, second half was very cool, and still somehow
yeah, so there were then losses which were happening on the LPG front. Refining margins, which are also big, you know, contributor to their integrated margins, those were weaker. So what you're seeing now is your refining margins have improved, marketing margins are good, LPG losses have come down, and in a way, the slightly surplus marketing margins can offset the LPG losses. So what happened last year was because there was this big LPG under recovery hole, their reported earnings were, I would say that they were sort of underreported in some senses because they could not account for these, you know, LPG receivables. And this situation may not recur this year. So there is potential upside to, you know, earnings for these companies. And in fact, the fact that refining margins are doing well right now also works well for Reliance. So you were talking about base effect. The near-term base effect is very favorable for Reliance because last year, Q1, their O2C was a very soft quarter. Retail, if you recall, had a couple of periods of slow growth. Which has again turned around. Last year, Jio was the pre-tariff high quarter. So even for Reliance, this actually works quite well in the near term.
Great. 5 minutes left. I'm going to do a bit of a rapid fire here. Saurabh, I'll come back to you first. Yeah. Telecom. Does Bharti Airtel remain a smart investment candidate? What is your call there and what's the rationale there?
Yeah, I mean, our sort of medium-term outlook on the stock stays remain very positive because the kind of earnings visibility that it provides amongst large caps is potentially, you know, clearly worth awarding a higher multiple to. But we also like Indus Towers. I mean, that stock is cheap, very attractive dividend yield. There was a little bit of a disappointment on the dividend front a couple of months back. And if that gets addressed, then that stock would also be a good candidate in our view.
Okay, thanks for that. Kunal, I'll come to you. NBFCs, we didn't discuss that. Is this the time to load up selectively on NBFCs because the cost of funds will come off and therefore there might be a good period, or no, not
Yeah,
quite?
so selectively is a good word, I would say. You need not paint the entire NBFC with the same brush in the falling interest rate scenario, because in many of the product segments, you don't get that kind of a pricing power.
Okay.
And you need to pass on the funding cost benefit. So selectively, maybe in few of these segments wherein you are able to retain the cost benefit and you clearly have niche and differentiation, that would really help. And that's where Shriram Finance is the pick for us within the NBFC. So maybe on the used vehicle side, on the business lending side, on the affordable is where you will see some kind of a retention of the funding cost benefit and better earnings growth.
Okay, what else within that pack? Gold loan, microfinance, anything at all? Or
So
no,
we
not
don't
quite?
cover many of these names.
I
Yeah.
thought as much.
Yeah.
Okay, okay. Fair call. Arvind, excuse me for not knowing, but does aviation fall under your bucket?
Yes, we cover Indigo.
So would you be able to talk about Interglobe at all?
Sure. So we are quite positive. We have a buy on Indigo Airlines. I think there are lots of tailwinds. The demand is very strong, which we see in numbers. There was a bit of a disruption in April, May, but after that we've recovered well. I think Forex is something which has been quite positive for them as well. At least in fourth quarter, it was quite positive. They have just placed an order for more planes. So international routes are expanding. And the market share is very strong, above 60% for quite some time. So we remain constructive on the sector per se in terms of demand, and even for the company, I think there are quite a few tailwinds for profitability for the company.
The promoter overhang, that 8% is not that large anymore, I presume.
It has been reducing. Obviously, when the sell-offs happen, it has been reducing. So naturally, it's not that big of an overhang now as it was maybe a few years back.
Okay, great, thanks. Surendra, can't not talk about IT, but the sector which has been debated the most since the start of the year. I don't think there are clear answers, or are they? How do you think about it?
Yeah, so what we have seen is we went into the year with a lot of optimism. And after that, the first quarter, and this is pre-Liberation Day, the sector underperformed a fair bit. Even today, as we said, it's underperformed the broader market by 18-19%. So now we get different kind of questions that the underperformance is already there. Maybe the worst of tariffs is already the base case. And to that extent, people are turning a bit more optimistic as far as the sector is concerned. Our view on the sector is still cautious.
Okay.
And again, our view has been cautious for a while now.
For a while now.
Because our view still remains that even pre-tariffs, growth in the last couple of years has been slow. If you look at FY23, 24, 25, growth was low to mid single digits. And there are multiple other issues which the sector has been facing. Okay, firstly, I think the AI deflation is something where there is a lot of debate on how it impacts the existing business, particularly in a challenging macro setup. Secondly, GCCs is again another big part of the debate. So I think there are multiple things which the sector needs to see, and it's obviously a large sector, so that law of large numbers is also at play. So we continue to see moderate growth in this sector. This year, FY26 will be a slow year, even in the context of the muted last 2 years. And then let's see how FY27 plays out. There are still a lot of moving parts. But at this point of time, we are not expecting a big recovery. We go back to mid-single digit kind of growth rates. So that is the broad framework. And in that, I think the valuations where we are today, they clearly don't seem that appealing. Like we find a lot more opportunities on the domestic side of the Indian market compared to IT services.
Got it. Some arguments, Surendra, that if indeed the world has to move towards AI, who will handhold them, and therefore Indian IT service companies come into play there? How, also that whole enterprise software overhaul, so on and so forth. How legitimate, how strong are these arguments?
No, so see, there is definitely merit in these arguments, but I think one also needs to keep in mind that there is an existing business. Yes. Okay, and these are large companies. They are incumbents in a lot of client situations today. What does AI do to the existing business? You can't kind of look at one pocket which is incremental and say, okay, that this part will grow. You also need to think about 100% of the business today. How does that get impacted? And in IT, in technology in general, for mature companies, the outcome will always be a function of multiple moving parts. There will be an existing business which is getting impacted by technology change. There is a new business which is benefiting from technology change. And if you look at just one part of that picture, I think you'll always get the wrong answer. So I think you'll have to look at both these moving parts together, and that combination is still not giving us enough confidence to say that we see a big growth acceleration going forward.
Valid point. One more argument on this, just the argument that people are making, that over the course of the next few years, let's say, if the dollar value is going to come off, then the reported dollar revenues per se, or reported rupee revenues get impacted. And is that something that will be viewed negatively, you think?
No, see, like our base case is never, rupee is not the main variable. Like we have never kind of considered it. Our view is more fundamental here. Having said that, I think rupee, like the rupee depreciation historically does provide a boost, firstly to the rupee numbers which Indian investors look at. And secondly, it is also a margin lever in the short term. Eventually, I think the gains get competed out or passed back. But in the near term, it can always help margins. So I think to that extent, yes, it's an additional thing to kind of keep in mind, but that's not like the key reason why we have a cautious view on the sector.
So you don't have a long view on anything, ER&D, small IT, mid-cap IT,
so
large
again,
IT?
like selectively, we like a couple of large caps relatively. But in general, ER&D at this point in the cycle is actually quite challenged, because the big benefit on ER&D over the last few years came from a very favorable EV cycle, which is clearly seeing a big challenge right now. So ER&D is actually most challenged. There are select mid-caps which are doing well, but there the valuations are very, very high. So clearly there is a lot of optimism already priced in. So our relative preference is for a couple of large caps, but again, that's relative. We have neutrals on them. So.
Okay, Surendra, as we wrap up, glass half full or glass half empty, FY26 for you?
So see, as I said, I think GDP growth looking up, right? Some of the recent data points positive. I think consumption, we should see a bit of a pickup. So I think things are trending in the right direction. That's how I would put it.
Great. Gentlemen, all of you, thank you so much for taking the time out and being with us. Really appreciate your time.
Thank you.
And viewers, thanks for tuning in to this very special conversation.